Investors wake up every morning to a financial landscape that frequently contradicts long-held historical beliefs. Many people watch global equity markets plummet and instinctively expect traditional defensive assets to soar simultaneously. However, the reality of modern trading consistently shatters these outdated expectations regarding portfolio protection and wealth preservation. For decades, both retail and institutional market participants categorized gold as a perfectly reliable sanctuary against geopolitical instability and inflationary shocks. They assumed this shiny metal would always provide an impenetrable shield during times of severe economic distress and deep stock market corrections across the entire globe. Recent market behavior has completely deconstructed this defensive orthodoxy. During acute escalations of conflict, the precious metal experienced a dramatic sell-off exactly when conventional theory suggested a flight to quality should have bolstered its overall market valuation and provided investors with necessary downside protection against falling stocks. This fascinating phenomenon creates a definitive counter-narrative that exposes the significant limitations of using the metal as a tactical hedge. Analysts observed a profound shift in market mechanics where institutional rebalancing and immediate liquidity requirements completely overrode the traditional safe haven demand that investors historically anticipated. The transition from a defensive hedge to an investment asset represents a mandatory adjustment for modern portfolio construction. This is not merely a semantic distinction, but a fundamental shift in how financial professionals evaluate risk and return within highly correlated global markets, facing unprecedented levels of uncertainty. Tai Hui from J.P. Morgan Asset Management stated very clearly that gold did not work as a hedge against geopolitics. He emphasized that they have been arguing for quite some time that the precious metal is simply not a very good hedge against anything in the current financial regime. When you examine its correlation with equities or other risk assets, the relationship is not very consistent over time. The metal possesses a number of characteristics working against it even outside of massive geopolitical shocks that force sudden market-wide liquidations and widespread investor panic selling sprees. Its daily price volatility is remarkably high and often mirrors the wild fluctuations typically seen in emerging market equities. Investors must remember that the asset does not generate any income, which creates a significant cost of carry that penalizes tactical holders during prolonged periods of market consolidation. If individuals own the asset to enhance their return, because of the fundamentals of central bank buying, that makes complete sense. However, if people own it believing it can offset market corrections, they will find it is not a particularly reliable tool for that specific risk management purpose. The track record of the metal acting as a geopolitical hedge over the past 30 years operates effectively like a coin toss. Consistent upside delivery only occurred in approximately 50% of significant political events, which makes it a highly unreliable insurance policy for short-term risk management. For any security to be categorized as a functional hedge, it must demonstrate a high probability of negative correlation with risk assets during stress events. Unfortunately, the precious metal frequently fails to provide this necessary negative correlation precisely when leveraged investors require immediate protection from crashing equity prices. A major reason for this failure during crises involves the complex market structure of leveraged investing and margin calls. During a systemic market sell-off, cross-asset volatility spikes dramatically, which triggers forced portfolio rebalancing and immediate cash requirements across various highly leveraged equity and commodity trading positions. Because the metal is a highly liquid global asset, it gets sold not out of conviction, but simply to generate necessary cash. Instead of serving as a sanctuary, it becomes utilized as a liquid source of capital to meet margin calls and cover devastating losses in other markets. This liquidity run phenomenon confounds many retail investors who watch global stock markets plummet and wonder why the ultimate safe haven drops simultaneously. It was sold because it represented one of the last remaining sources of liquidity for funds facing immediate liquidation threats from their respective prime brokers. This stressful double jeopardy pattern, where both stocks and gold fall together, has occurred during several major historical crashes. It happened during the global financial crisis and the early stages of the global pandemic, when extreme uncertainty forced investors to prioritize holding cash above absolutely everything else available. Under immense liquidity pressure, the market exhibits a sell-everything behavior, where the correlation between different assets instantaneously rises. This represents a mechanical liquidity run rather than an asset failure, because participants must quickly raise cash, and the easiest asset to liquidate quickly is often their profitable metal positions. Only after central banks provide massive liquidity support and monetary easing does the price stabilize and eventually rally back as a debasement head. Sophisticated analysts argue that the metal cannot be considered portfolio insurance because true insurance is defined by actually being there when it is needed most. Another persistent argument supporting traditional allocations suggests the metal serves as an impenetrable hedge against the destructive forces of inflation. However, historical data delivers a clear verdict with significant caveats, showing it can be a potentially disastrous hedge for the 10 to 20-year horizons typical of modern investors. Researchers Claude Erb and Campbell Harvey demonstrated that the asset can lose a staggering amount of real value over several decades. From its peak price in early 1980 to the year 2000, it lost approximately 85% of its real purchasing power despite continuous annual inflation. While the asset might protect against inflation over the span of centuries, most human beings do not possess an investment horizon of 2,000 years. People need a much longer timeline to guarantee actual positive returns, making it a speculative choice rather than a reliable short-term inflation shield. Furthermore, these extensive economic studies found that changes in the real price were largely independent of the change in currency values. This means the value does not necessarily increase or decrease in response to currency fluctuations, making it a far less effective currency hedge than the general public believes. The true primary driver of pricing over the long term involves the critical relationship with real interest rates and monetary confidence. It tends to rise significantly when real interest rates are low or negative, and fall sharply when real rates are high and positive in the broader economy. Higher interest rates increase the opportunity cost of holding non-yielding assets, making bonds and savings instruments relatively more attractive to capital allocators. When central banks enforce restrictive monetary policies, the resulting positive real yields compress returns and push cautious investors toward assets that generate reliable and consistent income. A stronger United States dollar also creates significant headwinds, because the metal is priced in dollars on the global exchanges. When the dollar appreciates against other major currencies, it typically becomes more expensive for international buyers, which consequently reduces overall global demand and suppresses the nominal spot price. Despite these documented failures as a tactical hedge, its role as a strategic diversifier remains mathematically sound for long-term wealth building. The traditional stock and bond portfolio mix is increasingly ineffective in an environment where equities and fixed income assets frequently move together during severe inflation shocks. The transition from a defensive tool to a strategic investment asset is most visible in the aggressive behavior of the official sector. Since geopolitical fragmentation intensified recently, central bank net purchases have doubled, reflecting a fundamental rebasing driven by strategic necessity within an increasingly weaponized global financial system. Billionaire investor Ray Dalio argues that the metal is now better understood as the second largest reserve currency and the safest money. In a capital war environment, assets linked to a specific government become highly vulnerable to sanctions, confiscation, or sudden devaluation by desperate political leaders seeking financial leverage. Being nobody else's liability, it serves as a completely neutral reserve asset that carries absolutely zero counterparty credit risk for the holder. Official sector demand patterns from major emerging markets illustrate this massive trend, as institutions seek forms of money least at risk of fiat expansion and monetary debasement. Between the year 2000 and 2025, the global above-ground stock grew at a slow rate of roughly 2% annually. Meanwhile, fiat money supplies increased at substantially higher rates, making the physical scarcity a mathematical advantage against currency debasement over exceptionally long macroeconomic cycles. This strategic institutional demand operates entirely independently of fear indexes and short-term market panic indicators that drive retail investor decisions. During intense sell-offs, while speculators exit positions to raise liquidity, central banks act as the ultimate buyer of last resort, establishing an incredibly strong and durable price floor. World Gold Council research suggests that adding the asset to an investment universe can result in a material enhancement to portfolio efficiency. A hypothetical portfolio with a 10% allocation achieved higher risk, adjusted returns, and lower maximum drawdowns than a standard mix over a comprehensive 20-year period. The optimal amount varies according to individual asset allocation decisions and the specific level of volatility risk present in the base portfolio. Broadly speaking, the analysis suggests that higher equity risk requires a larger proportional allocation to offset potential turbulence and shift the efficient frontier upward for the investor. However, experts caution that allocations exceeding 15% tend to create a massive drag on long-term compounding and wealth generation. Equities historically generate much higher real returns through earnings growth, corporate innovation, and the powerful mathematical advantage of consistent dividend reinvestment over multiple decades of continuous market participation. Professional allocators should maintain a 5 to 15% core position, not expecting it to rise during every single conflict or inflation spike. They should hold it knowing its fixed supply and fundamental money status will preserve capital over decades as the global monetary order continues its structural transition. Modern portfolio construction requires moving completely away from tactical market timing toward disciplined and highly strategic asset allocation methodologies across all environments. Trusting the metal for short-term risk management is a dangerous game that likely leads to systemic failure for investors who completely misunderstand its true market behavior. The evolution from a physical sanctuary to a sophisticated investment asset is also heavily driven by massive changes in underlying market structure. The astronomical rise of exchange-traded funds has successfully democratized access, but simultaneously introduced entirely new forms of price volatility and high-frequency algorithmic trading dynamics. These modern financial instruments allow algorithmic trading systems to amplify short-term price movements through incredibly fast momentum-based mathematical signals. Huge jumps in short interest demonstrate that many aggressive traders now position for near-term weakness, even as serious geopolitical tensions rise continuously across the entire global landscape. This clearly demonstrates that the asset is currently being traded as a tactical secondary question of precise market timing rather than value preservation. Many market participants ignore the strategic primary question of long-term capital protection in favor of chasing rapid speculative profits through highly leveraged derivative trading vehicles. For investors seeking explosive growth rather than mere protection, mining company stocks offer tremendous operational leverage and significant capital appreciation potential. These businesses are analyzed as industrial enterprises, where corporate profit margins can expand disproportionately fast relative to the gradually increasing spot price of the underlying physical metal itself. An emerging dimension of this transition involves its integration into environmental, social, and governance frameworks utilized by large institutional portfolio managers. Responsibly produced assets from supply chains adhering to high standards can potentially reduce investor exposure to climate-related risks and support broader sustainability objectives within modern financial strategies. While the mining sector is by definition an extractive industry, responsible operators follow stringent frameworks to mitigate environmental impact and reduce operational risks. Lack of downstream emissions means holdings can actively reduce the overall carbon intensity of the portfolio value, which greatly appeals to increasingly conscious global institutional investors. Furthermore, the value is far less likely to be negatively impacted by a rising carbon price in the future decarbonized global economy. This offers investors a valuable degree of financial insulation from the likely policy responses needed to accelerate the urgent international move toward a completely net zero carbon environment. When constructing a resilient portfolio, it remains crucial to thoroughly acknowledge and deeply understand not only the potential opportunities but also key risks. The widely perceived drawback that it does not provide a regular income like bonds or property means investors depend entirely on price appreciation to achieve any benefit. Despite the lack of yield, the asset has generated long-term positive returns in both good and bad economic times across many decades. Its strong performance is no random coincidence, but rather a direct byproduct of underlying demand and supply dynamics combining natural scarcity with diverse global consumption sources. The diversity of its demand sectors spanning technology, jewelry, central banks, and retail investment helps make it a remarkably well-rounded, efficient asset. During periods of economic expansion, pro-cyclical consumer demand from the technology and jewelry sectors strongly supports its performance and stabilizes the overall global pricing structure. Conversely, during periods of intense economic uncertainty, it is the massive counter-cyclical investment demand that violently drives up the spot price. This unique dual nature as both an investment vehicle and a consumer good provides a particular resilience that purely financial assets simply cannot replicate under extreme market conditions. The scale and profound depth of the global market means that it can comfortably accommodate exceptionally large buy and hold institutional investors. In stark contrast to many other financial markets, the liquidity does not mysteriously dry up even at times of severe financial stress and widespread banking sector panic. This exceptional liquidity feature allows investors to meet urgent financial liabilities when other less liquid assets in their portfolio become incredibly difficult to sell. It effectively functions much more like an insurance policy than a traditional investment, offering outsized returns exactly when the broader financial system goes completely awry. However, experts maintain that referring to it as an infallible safe haven remains a dangerous misnomer that creates entirely false expectations. Professional allocators prefer to correctly characterize the metal as a powerful return enhancement tool, driven primarily by massive sovereign entity accumulation and the ongoing global fiat debasement trade. Investors who cling stubbornly to the outdated defensive hedge narrative will inevitably face severe disappointment during the next sudden market liquidity crunch. They will watch in horror as their supposedly perfectly safe asset plummets in value right alongside their crashing equity holdings, while margin calls completely decimate their leveraged accounts. The financial paradigm has witnessed a fundamental and irreversible deconstruction of the traditional orthodoxy surrounding the role of precious metals in portfolios. We must collectively stop treating it as a magical shield that automatically repels all financial damage and start treating it as a highly complex strategic alternative investment class. Viewing it purely as an investment asset demands a rigorous shift away from emotional tactical market timing toward disciplined strategic asset allocation. Participants should establish a core position and hold it firmly through inevitable volatility, knowing that its fundamental monetary status will efficiently preserve capital over several coming decades. The data overwhelmingly supports holding both equities and precious metals in appropriate proportions, strictly aligned with your personal financial circumstances and goals. The compound annual growth rate advantage of stocks becomes absolutely compelling over multi-decade periods, but the metal dramatically reduces overall portfolio volatility during terrifying market crashes. Rather than falsely choosing between these two titans of the investment world, intelligent allocators build a balanced approach that perfectly harnesses both strengths. They closely monitor market ratios and other technical indicators to guide periodic portfolio rebalancing, while completely avoiding the fatal temptation to abandon either asset based on recent performance. The ongoing political uncertainty and deep economic concerns surrounding equity and bond markets strongly indicate that strategic demand will likely continue expanding. Central banks and sovereign wealth funds will persist in purchasing massive quantities to diversify away from weaponized currencies and successfully protect their national wealth against extreme devaluation scenarios. Retail investors must quickly learn to adapt their outdated mindsets to this rapidly evolving and highly complex macroeconomic reality we face today. Expecting a perfectly negative correlation during every single crisis is mathematically foolish, and ignores the harsh lessons taught by recent liquidity-driven sell-offs that punished all asset classes. To truly succeed in the new era of fragmented global markets, one must recognize that this shiny asset is no longer just a sanctuary. It has transformed into a critical and highly sophisticated instrument for the modern portfolio that demands precise sizing and a deep understanding of shifting international monetary mechanics. When properly utilized as a strategic long-term investment rather than a short-term tactical bandage, it can materially enhance risk-adjusted returns. The empirical evidence proves that while it fails as a consistent tactical hedge, its utility as a foundational wealth preservation vehicle remains absolutely profound and mathematically indisputable. It serves beautifully as a strategic reserve against the aggressive weaponization of capital and acts as a powerful mathematical diversifier in a correlated world. It stands as a proven long-term store of value against the inevitable and continuous debasement of fiat currency that central banks actively orchestrate across the globe. Ultimately, recognizing the asset for what it truly is represents the most important step any investor can take toward building durable generational wealth. By completely discarding the flawed safe haven illusion and embracing the strategic investment reality, market participants can successfully navigate the terrifying storms of our modern financial system.